Hello, everybody. I can't thank you enough for taking time out of your day for another webinar, and I think this webinar is going to be probably one of the best. It's near and dear to my heart. I think you all know by now that women and wealth is very important to me. I think it began, I lost my mom when I was 10. She was only 31, and ever since, I've always tried my best to make my mom proud, and I've been in business 33 years and helping women with their finances has always been something that I wanted to excel at. And this year we put a lot of resources into our Women in Wealth campaign, and you're going to see us really step that up. And I can't begin to tell you just how excited I am. So today we're going to talk about finance tips for women and their wealth. And I've asked Nicole Goebel, Harmony Wagner, and Samantha Macy to really lead the charge with today's webinar. Nicole is one of our senior wealth advisors, CPA, certified divorce financial analyst. Not that we want you to use those services, but if you ever know of anybody who may need them, Nicole is an expert there. And Harmony, one of our wealth advisors, a certified financial planner. The same with Samantha Macy. They're going to be your presenters today. And in today's webinar, we're going to go over investments, tax planning, and risk management. So without any further ado, I'd like to have Samantha start off the webinar.
Thank you, Steve. Hello, everyone. My name is Samantha Macy. I'm one of the wealth advisors, as Steve said, and a certified financial planner. And before we jump into these topics today that Steve just went over, I really wanted to start with some impactful information about women in the workforce and really why we're having this webinar in the first place. So, first, I want to say that women aren't a minority or a niche. And this is something that we've seen in the industry, that sometimes women can be lumped as a minority or put in this box, and that's simply not true. We are 50% of the population, and 47% of the labor force consists of women. And actually, 50.2% of the college educated workforce is women, which is a great statistic to see. And lastly, the majority of families today are dual income, which means that both spouses are working, both are generating income. And this is another reason why it's important for us to plan for women as an equal part of the workforce, not as a minority. So we partner with a firm called Dimensional, and they recently did a study that asked people, how do you primarily measure the value received from your advisor? And the top answer that they received was sense of security and peace of mind was the top value. And this was across the board, whether you were a male or female. And it became even more important for people that were widows. So we just found this a very interesting statistic and one that we want to keep in mind as we work with our clients. So now that I've established that women aren't a minority or a niche, I do want to say that women have some specific needs that need specific planning tailored for them. And that comes with unique challenges. So if you look down at this chart below, I have 3 categories of unique challenges that women face. The first is their spending phase. And this really has to do with women just living longer. On average, women outlive men by 5 years. And we recently found the staggering statistic that the average age a woman becomes a widow is 59 years old, which I personally found shocking and definitely warrants some planning around that. Women also tend to have greater healthcare costs over time, again, because they're living longer and maybe they've lost their spouse who would have been their caretaker within the household, and now they need to outsource that and pay someone for their care. The next unique challenge area is women's ability to save wealth. In general, women have lower potential lifetime earnings. And I'm sure we all have heard the conversation around women earning a certain amount on the dollar compared to men in similar roles. And I recently just read a statistic that 4 out of 10 women earn less than their male counterparts in the same position. However, we're not going to really dig into that larger conversation. I mainly want to focus on one of the main factors behind this, and this is when it comes to family planning, women tend to be the ones that choose to stay home and raise their kids. And that's just a common thing that we as women choose to do. And whether that is deciding to be a full time stay at home mom or taking some gap years, it does impact your overall lifetime earnings. Even if you take a few gap years and you re enter the workforce, oftentimes you're taking the same salary that you took when or that you were making when you exited the workforce and missing out on those years of potential salary increases. Another factor here is financial setbacks due to divorce. And I'm not saying that men also don't have financial setbacks. Of course they do. But we recently read a study that basically explained how women suffer greater setbacks due to divorce and greater long term impacts on their financial health. And that certainly warrants some planning. And as Steve was saying earlier, Nicole is a certified divorce financial analyst. So we have the resources to help you through that stage of life if that does happen. The last unique challenge I have for women is their ability to grow wealth. And just speaking in very broad generalizations, I want to focus on risk tolerance. Now, when men invest, they tend to be more risk on, and they do tend to lose more money in the stock market than women, but women tend to be more conservative investors. Of course, not all women fit into this box. There are plenty of women that are comfortable with taking on higher levels of risk. But overall, we want to make sure that women aren't being too conservative, which would be a detriment to their long term financial plan because they're not allowing the growth opportunity in their portfolio to reach some of their financial goals. So that's just something to keep in mind as you're working with your advisor and planning for your future. So now that I've kind of talked about some of this impactful information about women, I want to focus on investments. So first off, there are different types of investments or asset classes. I'm sure most people are familiar with stocks and bonds. We also use some alternatives in our portfolios, and this can be an area that where we receive questions because it is a bit confusing. These assets that don't fully fit into stocks and don't fully fit into bonds, but are more of a mixture of the two. Some examples would be preferred stocks or real estate investment trusts. Another area that we receive questions are around mutual funds versus exchange traded funds, also called ETFs. And in our portfolios, we primarily use ETFs. And that's for a few reasons. First is that they are lower cost. They do not have a fund manager associated with them like a mutual fund does. They also are tax efficient, and they also have greater returns over time, greater than a mutual fund historically. So those are the three reasons that we primarily use ETFs in our portfolio. Now that we've talked about types of investments, the next step is what's the appropriate portfolio allocation for you as an investor? And the first pointer here is you want to make sure that you have good diversification. You don't want to be invested 100% in one stock because if that one stock starts performing negatively, your whole portfolio goes down. So we want to make sure that you're invested in different asset classes and different types of stocks, bonds, and alternatives within your portfolio to make sure that you're mitigating that risk. When we also think about your portfolio allocation, we want to make sure you have the right risk tolerance selected for you. And when I say that, I mean what level of risk are you comfortable taking on as a client and it won't keep you up at night? And this needs to be decided in conjunction with your financial plan. We never want you to invest in a vacuum. You need to make sure that you're also taking into consideration your age. How long until you retire? How long in retirement do you need these funds? What are some of your other financial goals you want to achieve? So you need to make sure that on top of taking on an amount of risk you're comfortable with, you also are allowing them the right amount of growth opportunity in your portfolio to achieve these goals. Someone that might not need to take on as much risk is someone that, when they retire, will start receiving a large pension. And let's say that pension covers a majority of their spending. They won't need to be as aggressive with how their allocation is than someone that maybe doesn't have a pension and is going to be relying upon Social Security and portfolio distributions for their retirement. So just things to consider, and they should all be part of the conversation that you're having with your advisor at that time. Over here on the right, I just have an example of our standard growth and income portfolio, and it's just a well-diversified portfolio, and we'd always be happy to have these discussions with you around what's appropriate for you. So now that I've talked about types of investments and portfolio allocation, let's talk about how to put these funds to work for you and help you fund your goals. You can see here in the graphic on the left, I have 3 types of goals laid out. The first is short term, then we have midterm and long-term goals. Short term are goals that can be accomplished within a year. Midterm take 1 to 5 years to accomplish. And long term are goals that take 5 years or longer. Now, over here on the right, I have some great examples of what these goals could look like. A common short-term goal is a lifestyle purchase. This can be purchasing a house or a car. And one of the main ways that you should be saving for this type of goal is a brokerage account. And this is because of the great flexibility that it offers you. You only pay taxes on any growth above your initial contributions into the account, and you don't have penalties for withdrawing earlier than a certain age like you would in a retirement account. I also would urge you to look into financing as an option. Now, with interest rates being so high, this is clearly something that, may not be as attractive right now. A good rule of thumb is if you can get a rate that's 5% or less, that is an attractive rate and one that you should consider. Another type of goal would be a midterm goal, and the most common one that we talk to clients about is saving for their child's education. And one of the best ways to do this is a 529 plan. We will often recommend this because they offer a lot of flexible options for qualified educational expenses and a lot of ways to use those funds without penalty if you don't use them for education. And we'd be happy to have a more in-depth discussion with you about that. New York State also offers a $5,000 deduction on your taxes for those that are filing single and $10,000 for 529 contributions for married filing jointly in that year. So great tax benefit as well. Lastly, a long-term goal that I have for you is retirement. Couldn't not mention it on this webinar. It's incredibly important that you are focusing on it regardless of where you are in your career and your family's financial health. One of the things that you should be doing is contributing to your employer plan. If you have that option, take advantage of it. It's a great way to be saving. Most of the time it's going to be pre-tax, but we're seeing that more and more Roth options are available as well. So it's a great way to start filling up both your pre-tax and your Roth buckets when you're saving for retirement. A good rule of thumb is to save 10 to 15% of your salary. And at the very least, you always want to be taking advantage of your employer match, which tends to be a bit lower, maybe 3 to 5%. So if you're doing the rule of thumb, you're going to be getting that employer match. So I'm going to hand it off to Nicole next, who's going to be talking about some of the tax implications of using these accounts that I was just discussing with you, and also providing some great tax tools for you to use in your life.
Thanks, Samantha. So now that Sam's gone over some of the basics around investments and different types of financial planning goals, let's talk about how to fund those goals. So if we take a look at the different investment accounts that Sam mentioned, right, first looking at those brokerage accounts. So as Sam mentioned, these are great for lifestyle purchases. You're funding these accounts with after-tax money. And all that's taxed is really, again, the earnings above that initial contribution in a couple different ways. First, interest and dividends that are earned within your account each year, you're paying tax on that, regardless of whether you're investing those dividends back into the same securities. Okay. And again, it depends on the type of income, what rate you're paying. But we tend to, again, be very tax efficient with our portfolios, have a lot of qualified dividends from the ETFs we utilize, which are typically taxed at about 15%. Capital gain distributions. This is something to certainly be aware of. Again, one of the reasons that we use exchange traded funds are they're more tax efficient than mutual funds. So in some cases, an actively managed mutual fund, you could at the end of the year, late December, get a big distribution or return of your initial capital and have to pay tax on that. And you haven't done anything to cause that tax issue. With exchange traded funds, that's very rare. So again, one reason we try to stick to ETFs versus mutual funds. And then realized gains and losses. So if you're selling an investment for anything more than you purchased it for, which would certainly be a positive, you're going to have to pay tax at the capital gains rate. So if you've held that investment for at least a year, then you can have the more preferential long-term capital gains rate, which is about 15% for most individuals. However, if you sell an investment within a year of purchasing it, you're going to be taxed at your marginal tax rate, which is typically higher for most people. Now let's talk about pre-tax retirement accounts. So as Sam mentioned, this is a great vehicle to save into to fund retirement. But what happens when you start to need those funds? Since you received a tax deduction on the contribution on the way in, now you have to pay tax on that contribution and the earnings on the way out. That's taxed at your ordinary income tax rate at distribution. As Sam mentioned earlier, brokerage accounts, there's no penalty for accessing at any age, whereas a retirement account, typically you want to keep the funds within that account until age 59 and a half. There are certainly exceptions, and we work with our clients to manage those if they're retiring much earlier. But again, as a general rule, try to aim to have those funds available after that age. Another thing to consider is pre-tax retirement accounts are subject to what's called required minimum distributions, or RMD. There's been a number of changes in the Secure Act and Secure Act 2.0 as to the age you have to start taking distributions from your account, regardless of if you need the cash flow. Currently, for anyone born under 1959, the now age is 73, whereas anyone born after 1960 will be age 75. Basically, the government's saying, hey, you got that nice tax deduction on the way in, but now we want our money while you're still living and enjoying your funds. Roth IRAs are a fantastic vehicle. As Sam mentioned, there are many retirement plans now that offer a Roth option. You're not getting a tax break on the way in, but that contribution and all its earnings are growing tax-free for really your lifetime. It's not subject to required minimum distributions, so you don't need to start taking that out at a specific age. As a general rule, again, you want to use this as a long-term account to fund retirement, or keep the funds until 59 and a half, or at least 5 years for your contributions to avoid any early withdrawal penalties. There are, again, exceptions where you can use a Roth IRA for a first-time home purchase or medical or education expenses. But again, as a general rule, we look at it as more of a long-term planning vehicle. The last thing to consider for Roth IRAs is there is an income limitation as to who can contribute directly to a Roth. So make sure you're working with your advisor or tax preparer to ensure that you're qualified and eligible to make that contribution. But again, that's a great benefit to an employer Roth plan, as they don't have that same income limitation. So now that we've talked about the different types of investment accounts and how they're taxed, let's just talk about some general tax tips to ensure you're not paying any more than necessary. We love to educate our clients as to how to avoid interest and penalties from the IRS or the state. And one good rule to go by is just understanding the safe harbor rules. If your income last year was under $150,000 before you took any deductions, all you need to pay in is 100% of last year's taxes, and you're good to go. You can pay the balance when you file your taxes. The other rule is 90% of the current year. If your income was over $150,000, you're going to want to pay in 110% just to be safe. When would it make sense to pay in only 90% of the current year? Well, as an example, if you've now retired and you have a lot less income, you're not going to want to pay based on last year's taxes because, again, you're going to end up in a big refund position. But again, just think about these things and work with your tax preparer and your advisor. You also want to determine what amounts to withdraw from which type of account each year. So we work with each of our clients on distribution planning. So some things to consider are, again, where are you going to be as far as a tax bracket? Does it make sense to take a little bit from a Roth IRA or a brokerage account rather than all of your funds to fund retirement through a pre-tax account? We often see clients make the mistake before working with us of spending down their brokerage accounts early in retirement, and then every dollar they take out from a pre-tax retirement account is taxable, and they end up back in a very high tax bracket. So really making sure that you're planning long term when thinking about distributions so that you're in a lower tax bracket for the long term versus for a few years. And something to definitely consider are what are the different state retirement exclusions you can take advantage of. In New York State, although we are painted as a tax unfriendly state, in fact, we're pretty generous here in that your first $20,000 once you reach age 59 and a half of retirement income, whether that's IRA distributions or a pension, is exempt from New York State tax. So for a married couple, they can have their first $40,000 tax-free, plus Social Security is not taxable in New York. Another thing to plan for is Medicare premiums. Because Medicare has a 2-year look back, you want to think about this starting in your early 60s and really planning for it. Because if you're only $1 over the Medicare income tax bracket, you're going to end up paying hundreds or even thousands of dollars of additional premiums unnecessarily. So really, it's important to think about this. One other consideration is if you have the reverse, you're still working when you're 65, you're making a high income and your Medicare premiums are higher, but then you retire and your income's substantially lower. When you get your Medicare premium the next year, it's not going to have changed because, again, there's that 2-year lag. So there is a form that you can fill out, and we work with our clients to do this, to request a change in your Medicare premiums or for them to lower them proactively. And last but not least here, Roth conversions. We have so many clients that come and ask us, is this the right strategy for me? And it certainly can be for clients who retire relatively early and they have some low tax years before they receive a pension or Social Security. It can be a great time to move some funds from pre-tax retirement accounts that would be subject to required minimum distributions to Roth accounts that would not be. They're also a great estate planning tool. We often tell clients that consider that any taxes that you pay on a Roth conversion today as a gift to your heirs, because when they inherit those accounts, although under the Secure Act they will need to withdraw within 10 years, there won't be any income tax burden. And last but not least, I wanted to talk a little bit about some tax planning around charitable donations. We have so many clients that love to give back to the community, to their church, to area organizations, yet they're no longer getting a tax deduction because they're utilizing the higher standard deduction and no longer itemizing. One thing to consider is bunching deductions into a single year. For again, example, if you use $5,000 a year to various organizations, maybe only do that every other year so you can bunch them into one single year and receive that tax benefit. Donating appreciated stock or funds or ETF is also a great way to give to charity. You can take the full deduction for the fair market value of that security and never pay on the capital gains. Also setting up a donor advised fund. We do this for our clients at Schwab often, where they're making one large donation, but then they're able to spend down that charitable account over many years. So again, you get that deduction up front, but now that it's no longer technically in your name, you get to spend that down over time to various organizations. And last but not least, using qualified charitable distributions or QCDs. It is allowed after age 70 and a half, which was the original required minimum distribution age. However, most individuals would not use that until they have to start taking distributions. Each individual can donate up to $100,000 per year from their RMD to various organizations. And the key here, it's going directly from your IRA to that charitable organization. But it's important to work with your tax preparer on this, as it is a manual adjustment you'll have to make on your tax return. So now that I've talked about different tax planning strategies, I'm going to turn it over to Harmony, who's going to talk about other risk management tools.
Thank you, Nicole. We're going to switch gears here for a moment and talk about another important element of your financial life that many people may not think about as the first thing that pops into their mind when they're considering building their wealth and how much to save and how to invest over time. But truly, when you think about it, if you don't take steps to protect what you have and what you've worked so hard for, then you're exposing yourself potentially to a number of different risks. So we're going to talk about some ways to protect yourself from those. Looking at some sort of broad categories here, the first one we'll examine is liability insurance. Now, many people just assume that their existing homeowners and/or auto policies will cover any liability events that may come up. It's true that there are state minimums for the liability coverage under either of those kind of policies. However, when you really look at the numbers and think about, what that kind of situation could potentially look like, God forbid, if you ever were in one, you may find that you may be underinsured a little bit. So for example, in New York State, the state minimum for an auto policy for a bodily injury resulting from a motor vehicle accident is $25,000. That's the state minimum that every policy would cover if you were to injure someone else with your vehicle. The average hospitalization bill for someone who has been in a motor vehicle accident is about $60,000, according to a recent study. So you can see that you're exposing yourself to about $35,000 in potential liability that your policy, unless you've improved the liability coverage on it, would not be covering. So it's worth it to look at your current property and casualty insurance and make sure that, if you feel that you're maybe underinsured for any potential liability events that you would increase that. You could also pursue what's called a personal liability umbrella policy. And just like it sounds, it covers a broad range of different types of liability events that could occur, whether it's something that you are responsible for, or someone who lives in your home, or someone who happened to be on your property. It covers a wide range of different things, and as well as someone using one of your vehicles. It tends to be relatively cheap considering compared to the coverage that you get. Many of our clients are able to get $1 to $2 million in liability coverage for a very reasonable monthly premium. So that's something that's worth pursuing as well. Another avenue as opposed to increasing the liability on either your home or your auto. So something to think about when it comes to protecting yourself from a liability event. Life insurance, of course, is another important area. The risk of what would happen to, your household financially if you were no longer in the picture. For most people who are working, that means, considering it from an income replacement standpoint, you can look at, what are my large debts that I would want to be paid off if something happened to me. What are my major goals? So I want to send my children to college, and that would be maybe difficult if I was not here, still working, still generating that income for the household. I'm worried that my spouse who's left behind wouldn't be able to accomplish that goal. So thinking about both your obligations and your potential goals that are outstanding in your lifetime can help you determine what's an appropriate amount of coverage for you. Another way to use life insurance is as an estate planning tool, because life insurance proceeds are nearly always tax-free to the beneficiaries. So they can be a great way to facilitate a tax-efficient wealth transfer at the end of your life. So that is a way to think about it as well, or to have it cover the expenses that come with someone passing away. So funeral expenses, final expenses, things like that. You can consider life insurance in that capacity as well. A third category is disability. And it's actually more likely that a person in their working years become disabled on some level and unable to continue in their current position, as opposed to that they would lose their life prematurely. So disability is an important one as well. For many people, your employer offers some coverage, whether they pay for it as a benefit to you or they offer it at typically pretty attractive premium rates that you can elect to pay out of pocket yourself as part of your benefit package. So something to consider is to look into that, see how much you are covered for. And then if you think that it may not be enough for you to continue your existing standard of living if you weren't able to work anymore or weren't able to do the same thing you do now, then you can consider supplemental or private coverage to bridge the gap. Next, we'll talk about an area of risk, a large potential expense that many people are worried about. And as Sam mentioned earlier in the stats, for most women, they're more likely to be the surviving spouse in their marriage. And so their healthcare costs tend to be higher because they may not have a spouse around to take care of them if they do need that kind of care. We look here, we see some of the statistics for the cost of long-term care on an annual basis. This is from 2020 and 2021. These costs just continue to go up, and they are quite expensive. And for anyone who's maybe seen a loved one go through this, has seen those kind of bills come in, how difficult that can be on a family. Not only of course emotionally with having your loved one deal with that, but from a financial aspect as well. There are several ways to approach this type of risk, and especially for so many of our clients, it's one of the main concerns they have as they approach their retirement in the later years of their life. So here are some few ways that you can approach it, whether you feel you want to take some type of proactive action or maybe another type of approach. The first would be to pursue traditional long-term care insurance. Another option I have here as a bullet point is a hybrid life/long-term care policy, which are becoming more popular. Those type of policies have a death benefit, which you can use for long-term care expenses. So you'd reduce the death benefit your beneficiaries would receive, but you can access that for long-term care costs. So you mitigate the risk a little bit of paying traditional long-term care, never needing it, having those premiums, have been paid without any benefit. You can do a kind of hybrid approach. There are some options there in that kind of space, but for some folks that makes sense. The premiums can be high depending on the kind of coverage that you're looking for, but there are some pros and cons, and certainly a peace of mind element for those who are interested and able to afford it and have that as part of their plan for this particular risk. Another option is more of a legal document route, is the Medicaid Asset Protection Trust. In this type of approach, you would move any assets that would potentially be at risk for being used towards long-term care expenses. You'd move it into a trust where it's protected. There are some pros and cons to it, so it's worth discussing with an advisor or an estate attorney if you become more serious about it. But that is a second way to kind of approach this question. And finally, you can choose to private pay and say, I don't know that I have a higher risk for needing this type of care than any other individual. If I do need it, I'm going to plan to pay out of pocket and self-insure, so to speak. So there are some different ways to approach it. And let's talk about asset protection. This applies to long-term care, certainly. However, it can also apply in other maybe less likely scenarios, such as a lawsuit against you or your spouse or some type of creditor situation. There are some protections that are offered to all U.S. citizens under law. And the first is the homestead exemption. Each state is a little bit different on the amounts that they cover, but they do protect the home that you live in, your primary residence, up to a certain threshold. In New York State, it's actually by county, but you can find it easily online to see, how much of the value of your home is going to be protected in a situation where your assets are going to be used or seized for something else. So that is something to think about. You're not likely to be put out on the street if an event like this or a situation like this arises. There is a protection for your primary residence only. Retirement accounts and 529 accounts, because they have such a specific purpose, are also protected to an extent. Again, this can vary by state, so it's worth looking into your state laws. But for retirement accounts, an employer plan or an IRA rollover that received funds from an employer plan, that has unlimited protection in New York State for a creditor type situation. If you needed long-term care, the only amount that would be assumed to go towards those costs would be, what's considered the payout amount, almost like you would be assumed you were taking RMDs, you'd be put into payout status. So a small amount, perhaps starting at 3 to 5% of the account is assumed to be going towards long-term care expenses. But besides that, nothing else from that retirement account would be taken. It's protected for your heirs. You can also use legal planning, as I mentioned before, to protect your assets and income, things like trusts, or in some cases, changing the titling of assets. Maybe you have a joint account and you're worried about, one spouse potentially moving it to the other spouse's name. You can use that for a number of different situations, but it's something that your estate attorney may recommend as a part of your risk management plan. And finally, as we've discussed, at length in the previous slides, insurance, whether long-term care, liability policies, life and disability, and also the potential for some folks who have a higher net worth to self-insure for certain types of risks. Finally, I'm going to hit this topic briefly, and if you have more interest in it, it's of course such a broad area. My colleague Scott Strohecker and I recently did a webinar last month, actually, so you can go back to our archives if you want to see a really full-length webinar on estate planning. But it's such an important part of risk management. I couldn't, miss the opportunity to share a little bit about it. So real quickly here as we come to a close, the estate planning documents that almost everyone needs to have, just some bullet points: beneficiary designations on really any financial account that will allow you to have them, retirement plans at work, IRAs, investment accounts, even bank accounts allow them. A will is really important, and you can express a lot of your wishes in a will, so having that document up to date is key. An advance directive or living will, which defines your wishes for what measures should be taken for your health if you were in a situation like that, as well as medical and financial powers of attorney to name the people or person that you want making those decisions for you if you could not. For some folks, they need to pursue more complex estate planning beyond those basic documents I just mentioned. For example, if you have assets that are above the federal or your state estate tax exemptions, you may want to be doing some proactive planning to avoid paying estate tax if possible. If you have a loved one, either who has special needs and or who has not demonstrated that they have the ability, at least at this point in time, to manage money prudently, you can set up a trust to protect them and to protect the wealth that you're transferring to them. If you have a desire for Medicaid planning, as I mentioned on a previous slide related to long-term care, or if you have a complex family structure, maybe children from a previous marriage or a family business, anything that adds a little bit more complexity that may require some additional estate planning. These are all reasons why you may want to talk more in depth with your estate attorney and may pursue some more advanced strategies beyond the basic documents I mentioned above. That concludes the risk management portion of our discussion today, and I'll hand it back to Steve now to close.
Thank you, Harmony. And I can't thank Nicole, Samantha, and Harmony enough. Hopefully today you felt that it was worth your time to be part of today's webinar and the education that you get. I'm very fortunate. I'm surrounded by 19 professionals. 10 of them happen to be female, and they have expertise that you can use. If you feel that today's webinar is of interest to maybe somebody in your small circle of friends or family or peers, it will be up on our website real soon. In the meantime, thank you for taking time out of your day. I can't thank you enough for all the trust that you put in us, and we'll let you know what next month's webinar is about soon. Have a great day. Stay healthy. Be well.